Welcome into the four-piece, folks. 4 videos for me to react to, 4 little clips for me to react to in this one here today. First one up here. We expect the market correction to mature as early as next week, the selling to slow down or stop next week. Katie Stockton. And this is from a few days ago, so I'm assuming she's talking about this upcoming week. Want to watch that one, react to that one, kind of give my opinions and perspectives. This is the weakest bull market in the last 60 years, says Chris Toomey of Morgan Stanley. I want to hear what he has to say in regards to that. That's a big statement. Mike Wilson, we're seeing a breakdown in the stock market. And last one's a little 1-minute clip from Mike Wilson. Or actually, this is a longer clip from Mike Wilson. The other one's the 1-minute clip. We're 5% underweight equities, which that doesn't sound like that big of a number. Like, considering how bearish Mike Wilson's been all year, like 5% seems a little, did he get more bullish recently, or has he always been 5%? So appreciate everybody joining me as always. Thank you so much for being here, folks. Thank you for being subscribed to the channel. New all-time high in the history of the channel. Appreciate y'all. And let's jump straight into this.
Is here to talk about what could happen. We're really fascinated by bonds and interest rates. So we want to get to that in a second to see, because you did think we were in an uptrend for rates. But first, let's talk what our viewers care most about. Equities are kind of in a, is it a malaise? Is it a downtrend? Is it a correction? Seasonally, it's a weak time. Is it anything worse than what we should have expected?
No, not at this stage. So we have a correction within a cyclical uptrend at this point. Below 4,200, if we saw that support area taken out,
the S&P,
it would start to look like something worse, because the next support is around 3,900. But we do expect the correction to mature, and honestly, even as early as next week. The seasonal influences, as you know, are really weak in September. We have usually a much better October, November. I think the bigger question beyond a potential relief rally is how sustainable that is, and will it get us back above that long-term resistance, which is about 4,600.
Yeah. I don't know which. I think.
Okay, before we go further here and hear more of her opinion, okay, you know what's interesting? Do you guys remember last year and what happened in the market in October of last year? Well, I'll tell you what happened in October of last year. Last year in October, the market actually bottomed out, and almost all the stocks that were just plummeting all bottomed out throughout October. Some of them started bottoming in early October, some were more mid-October, and others were like very late October. So, yeah, fascinating. We'll see if it all plays out again. But that did happen last year, right? And then we started actually a nice uptrend into November, December. A lot of people thought that was just kind of like a bear market rally. And then we really got a rally, obviously, in the first 6 months of this year. And woo, man. But remember, that was mostly like big tech stocks and tech stocks in general. A lot of these value and dividend names have just gotten hammered this year.
Odds, I think, around the teens, like 13th, 14th, 15th. The odds of October, they just are bad. They're not bad. They're good because there's been so many bottoms, but they can be very frightening bottoms that occur in October over the years.
Yeah,
something like that.
Little washouts, right? And
why does this happen in October? Halloween?
It must be Halloween, very spooky. There is a Friday the 13th, I think, this one too. So who knows? But what I will say is that the sentiment is already somewhat washed out. I mean, we're not at 0% for the fear and greed index, but we did hit 25%. Which shows that bearishness has certainly increased, obviously driven in part by Treasury yields. We also have very oversold.
Yeah, we barely hit extreme fear in the stock market, literally this past week.
Market breadth, so that creates a backdrop in which the market, it's easier for it to go higher. So you have the combination of support nearby, oversold readings into the corrective phase, which is now played out as that kind of ABC correction. And with the sentiment backdrop better, it should release it to at least see some relief this coming month.
We should get used to whatever the S&P is doing, the NASDAQ does more easily.
High beta, yeah.
High beta.
So consolidation in relative terms, but we would
Dow
expect
less probably.
I think technology should outperform as one. You know, former leadership in general should outperform on the back of this corrective phase. I think we'll see a shift right back to the mega caps, but also we should see breadth improve off that oversold reading. So maybe the small cap benchmarks do a little bit better, or at least, you know, some kind of retracement.
Anyone thought?
I actually disagree with her. She's kind of making a case that money's going to rotate right back into big techs. And not to say those stocks are going to do bad, because wouldn't say that. But if we're talking about the next uptrend, I actually think these stocks that are going to way overperform are actually going to be a lot of the value stocks and a lot of the dividend stocks. Those are the ones that have been hammered the hardest this year. And so, you know, big cap tech, that's already had its run. And so, like I said, if we have an uptrending market, those ones will uptrend as well. I just wouldn't be surprised if several of those stocks actually underperform the market. And look at Apple recently. Apple's been severely underperforming the market here recently.
Near a high on the 10-year at 4%. That they're all gone. So now we don't know where the high is.
Remember, we were talking about 5.25, and everybody thought I was crazy.
5.25
doesn't feel that far anymore, does it?
No. Is that the high?
That is the next resistance for the 10-year yield.
And what's the resistance after that?
Oh goodness, I'm not even going to put out that number because I don't want to be held to it.
You don't. I don't want it to come out of your mouth.
Exactly.
Whatever that number is.
I don't want to upset people. It's Friday.
5.25.
What is it?
She's not.
It's in the sixes. So right. So that and
it must
listen,
be
it doesn't
666 maybe.
It doesn't mean it's a magnet by any stretch. That's not the nature of resistance. It's just the next hurdle on the chart. So this 5.25 though holds importance. It's the highs from 2006-07. And when we look at a treasury bond benchmark like a TLT, you certainly have a breakdown. That breakdown should be confirmed today. And yet there is still support. So if you go back to about 2009 on TLT, there's support around 87.5. So we feel that while we have a breakout in yields, a breakdown in TLT and the likes, that we will see consolidation for probably a couple of months. And that could also help the equity market recover to some degree.
Okay, I can't even believe what I'm hearing right now. Hold your horses for just a moment, okay? First off, I think if you watch my channels for long enough, you know I'm not the biggest believer in technicals, obviously, right? But the one thing I'll say is I'm even much less so a believer of technicals when it comes to the 10-year, okay? Or when it comes to TLT or anything like that. Those are fundamental decisions people are making, especially in regards to those. People will trade stocks based upon technicals, and it's not my opinion, but not my thing, but a lot of people do it. They'll sell out of stocks or they'll buy stocks based upon a technical reading, okay? When it comes to bond market and when it comes to people buying treasuries or not buying treasuries or all these sorts of things, like I just don't think those run on technicals at all. And I think it's just silly, just pure silliness. Okay. I believe it's silliness in regards to the stock market in general, but it's double silliness in regards to talking about TLT in the 10-year. Like that's just, I can't even believe what I'm hearing, but people can do whatever they want.
But you don't know where after that.
And that's the jury's out on the long term.
Bonds. You don't know where after that.
Oh, and bonds too. Well, we assume that the secular shift that we've seen in yields will maintain itself. But within that context, you can certainly see prolonged counter-trend moves. So we're looking for a counter-trend move in here very soon. That's in part based on our counter-trend measures like the DeMark indicators.
You're looking for a counter-trend that means yields will come back down?
Right. But sideways to lower, perhaps, yeah. And that should help equities. I mean, think about the influence on market sentiment from yields.
But we're in a totally new paradigm where it's going to be higher in general.
It seems like all of the trend following gauges, intermediate and long term, still do point higher.
Bitcoin has tested your support how many times?
For Bitcoin?
Yeah.
Oh, that 25,200 level.
Like
it's still
10 times.
intact. Yeah, I mean, it's proven to be a very important level for it.
Yeah, it's 27
so
today.
it's holding, but it's also not breaking out. So it seems a bit indecisive when you see this kind of consolidation. And, risk on, if risk on comes back to equities, well, maybe Bitcoin can actually break out.
Katie, just really quickly, taking what you just said and trying to put it to average people who maybe are not investors playing along on all this. If you're somebody who's about to look for a mortgage, you would tell them, get the 30-year fix. Do not sign up for an adjustable rate mortgage because you could be in for a world of pain if you do.
I think so. And when you look back at the secular downtrend that preceded what we're now, in the midst of, I think it's very feasible to see them higher for longer and even potentially much higher, unfortunately, if you're talking in several years.
You can always refinance, but it's much more painful to get out of an adjustable rate if rates go up. And
I don't think patience would necessarily pay off in that case, yeah.
And you wouldn't necessarily go to put all your money in a 10-year right now either, but would you wait a while?
Well, it depends on the time horizon, right? If you can get in and out, if I could, buy treasuries right now.
No, I mean, if you're, no, you don't want to be sitting on $80 of principal value for the next, a year from now, it's worth
Fair enough,
80.
for a year, yeah.
Okay, interesting. So So, just to kind of finish out thoughts there, because I think that's an important one. I do think our call in terms of the selling slowing down or stopping this week or next week, I definitely think it's a possibility. Especially when you talk about kind of the bullishness of November, December. We've got earnings that start to come out in mid-October, and then obviously a gauntlet of earnings at the end of October and the beginning of November. I think earnings are going to be just fine. I think some are going to be extremely encouraging, and I think that's going to also help out the market kind of likely into year end, outside of some extraordinary event happening that we never saw coming, or CPI going to some new crazy numbers, or the core or something like that, which doesn't seem super realistic right now. We're going to kind of be in this 3-ish range for a bit here. And then if we can get oil price to drop, we could be talking about CPI 2s ultimately in early 2024. But we need obviously some correction activity in WTI a little bit here, okay? Alrighty, next video up to react to. This is the weakest bull market in the last 60 years, says Morgan Stanley's Chris Toomey.
With the major averages on the cusp of confirming a sharp monthly decline. That may be all the reason why our next guest needs to stay defensively positioned. Chris Toomey, he runs one of the highest rated private wealth advisory teams in the country, joins us once again right now. It's good to see you. I mean, you've been largely defensively positioned for many, many months. I want your reaction to what David Tepper told me, Chris. It's not that complicated. You're just not in QE times anymore. You're in the QT era, higher rate environment. Can't be the same multiple as before. Not bad. It's just a different environment. What do you do with that?
No, I mean, it sounds familiar. We have been concerned specifically around the fall-off effects with regards to QE being removed and moving into QT. And we have also been concerned not only just about the pace of rate hikes, but also the duration of rate hikes. And so it seems like the market has moved away from the transformational powers of AI and the hope that rates were going to come down, and really focused in on what really is the side effects of rates moving so dramatically higher. And to David Tepper's point, not having QE and now being focused in on QT.
What's the right multiple for stocks, Chris?
I mean, it's twofold, right? If rates are here or potentially going higher, you'd have to expect multiples would have to start to come down a little bit. I think the bigger issue is going to be around earnings, right? So we've seen a situation where going into the year, we, like many of the others on Wall Street, were expecting GDP to be suboptimal and earnings to be down. And instead, we saw a real situation where the consumer stepped in. They had $2.2 trillion worth of savings, which they aptly put to work. We saw the federal deficit blow out 7.5%. And importantly, which people are starting to focus in on, especially because it's up over 30% this quarter, gasoline prices went from $5 down to $3, right? And so those are kind of one-off type situations that I could make the argument we're actually in reverse right now, with oil going back towards $100, and the consumer, instead of sitting on $2.2 trillion worth of savings, actually looking at a situation where credit card debt is over $1 trillion, and that debt payment is over 20%. So in addition to QT pulling liquidity out of the market, you also have credit card debt pulling money out of consumers' pockets.
So the flip side, I guess, is I hear you. I mean, those are all the risks that everybody who is negative or cautious the market would suggest you need to be keeping an eye on. But what about the idea of this fourth quarter chase? Money managers who just missed it from the beginning of the year. They were mispositioned, as some have suggested, and that's going to result in
a good question. I'm looking forward to hearing his answer in regards to this. Is a really good question.
Ash to the finish from those who want to get, at least while they think the getting can be kind of good. Who knows what happens next year with earnings? Do you put anything into that?
Look, I mean, that is a part of, the Wall Street kind of seasonality, right? Whether it's September being bad or window dressing at the end of the quarter or managers chasing at the end of the year. But I mean, let's dive into the numbers, right? So the market right now, S&P 500 up about 12%. You strip out the Magnificent Seven, it's up about 2 or 3%. You look at an area like healthcare, fairly defensive area, over 2/3 of those stocks are actually negative this year, right? So
yeah, so that doesn't matter though in regards to the whole subject at hand, right? The whole subject at hand is money managers needing to chase S&P 500. That's their benchmark, right? They got to chase that baby, and so at the end of the day, the client is not sophisticated enough for the most part. Otherwise, they'd be investing for themselves, right? They're not sophisticated enough to say, well, if we break out these certain stocks here, the market's only up ... percent, so we didn't do that bad. No, okay. The client just looks at the raw S&P 500 number versus what their manager's getting them. That's all that matters, okay? They're not any more sophisticated than that. Like I said, if they were more sophisticated than that and they understood all this, complexity in the market, they'd be investing for themselves. There'd be no reason. They understood, oh, let me strip out the 7 biggest stocks in S&P and okay, what's the return there? And oh, this is happening with dividend stocks and value stocks and here's why it's happening and higher for longer. And if they understood all that, dude, they'd be investing for themselves. They wouldn't need a money manager, right? So it gets back to the money managers need to chase potentially returns at the end of the year because we know so many of them went massively underweight into this year. And the indexes have ran away from them. And now they're like, crap, man. Like when people get their year-end statements, we need to be somewhat in the ballpark of the S&P 500. Right now, we're not even remotely close.
This is the weakest, quote-unquote, bull market in the last 60 years. And this is a situation where the majority of stocks in the S&P 500 are actually below their 200 moving day average, and 25% of the stocks are actually negative. So there's a little bit of deception with regards to what's going on in the market. So if you're a money manager and you're trying to chase this market higher, I think you have to be really concerned about how you chase it, right? Are you going to go back into these higher multiple stocks that are actually starting to sell off pretty dramatically? Or are you going to start looking for opportunities in names that have been beaten up? But my thinking would be that the economy and some of these other areas are just going to weigh on the overall market. And to David Tepper's point, it might make sense to be more cautious sitting in 6-month CDs that are paying you 6%.
But see, this so-called deception that you mentioned works both ways, depending on which way you want to frame your argument. Now, people who are, more cautious would say, well, the multiple on the market's too expensive. Look at it.
If I need to chase the market in a year end, I'm going Meta, I'm going PayPal, I'm going Amazon, and I'm going a few dividend stocks into year end. If I need to chase the market here short term, that's what I would play it.
19 times. There's no way the market's worth 19 times. Is it really 19 times? It really isn't.
And I'd have a hedge against Apple just in case the market tanks.
If you strip out the 7 stocks that we've talked about, the equal weight S&P, that's not trading at 19 times. It's obviously much cheaper. So it skews both ways depending on how you want to look at it.
That's right. And so I think your question is, what's going to drive this market higher? Is it going to be specifically money managers chasing and bidding up these stocks and pushing these index higher with those higher multiple stocks that are a bigger part of the index? Are they going to be looking at individual stocks in the underlying index that might not have as much to do with the index? Or do you look at a situation where you start playing defense because of all of the concerns we talked about? I think one of the things that people haven't focused in on, if you look at the fixed income market, right, we have a situation where the aggregate bond index is actually now negative. Bonds are down about 3% for the year. And you look across bonds right now, you're in a situation where the only thing that is actually positive are short-term rates. And if you look at corporates, September is typically a very busy month for corporates with regards to issuance. And this has actually been a very quiet month, which has actually helped corporate indices do pretty well. The flip side to that is if corporations aren't issuing debt because the cost of capital is so much higher, one of the other drivers for this market has been buybacks, right? And it was a lot easier to buy back stock when you could issue debt at really low prices and then go buy back stock. This is a different situation now because of what's going on in the bond market.
Yeah, sure. Fair play. But for companies that are cash flowing big money, they can still easily buy back shares like it's nothing, right? Already 2 Mike Wilson clips to the biggest bear on Wall Street this whole year. 2 Mike Wilson clips to react to. First one up here, we're seeing a breakdown of the stock market. Then we'll get to how underweight he is in the market. This is a little 1-minute one here.
We talked about this before. Do you still get the same degree of pushback that you did a month ago? Or are more people listening and saying, wait a second, in the anecdotal data, this is starting to make sense?
Yeah, look, I mean, I think the question for investors is always price. I mean, we're in a late cycle environment. Let me just set the table a little bit, right? So we're in a late cycle environment for the last year. And when you're in a late cycle environment, there's a lot of uncertainty, right? I mean, people erroneously called for a recession in the first half of this year. It didn't happen. And now they may be erroneously believing in like this beautiful soft landing with some reacceleration next year. They probably overpriced that in the summer. So what happens is investors get whipped around by price action. And I would say what's happened in the last 2 months is we are seeing a breakdown again in a lot of the stock market. Okay, yeah, the overall averages are down 4 or 5%, not a big deal. But some of these consumer stocks are really, really struggling. And I think that reflects kind of what we were talking about a minute ago before we get on air, which is that the middle, lower end consumer definitely is out of excess savings. That's starting to bleed a little bit into the higher end now as well. We have the student loan moratorium. And I just think that's the wild card. That is the risk for the fourth quarter is can the consumer continue to surprise on the upside?
So, his view there when he said, I'm going to set the table, right, of we're in a late stage environment, that's pretty much consensus view for the most part of like we're in a late stage environment and, kind of like an 06, 07-ish type time. I've been doing a little deeper thinking about this recently. And because I've been kind of thinking in that terms of that too, like late stage environment. But I always think, okay, if everybody's thinking the same thing, like where's the potential outlier situation here? And I was wondering and I was thinking, what if this is actually an early stage environment we're in? We just don't realize it and we already went through the late stage environment, right? The late stage environment was obviously the crash of 2020, was the resetting and the, let's call it pumping by the Fed. It was obviously the massive market drop we saw last year where the NASDAQ fell 37% peak to trough and we saw a buffet of the greatest companies in the world at 50 and 60 and 70% discounts, right? And then this year, the consumer stocks have been hit heavy. Stocks all over the place down 20, 30, 40, 50% that are very famous, like very well-known consumer-related companies, right? I have been considering, like, what if we're in an early stage environment? And, the difference between this and the great financial crisis was you certainly in the great financial crisis saw unemployment skyrocket in a massive way. But this has reacted maybe a little differently because of the stimulus, because of everything that the government did, and obviously continued government, plans that are going through. So there is a potential. We're in the beginning stages of a 5 to 10 year kind of, let's call it get better and healthier place. There is a potential. No one's considering that right now. And I think you always have to consider what no one's considering. Everybody's thinking late stage environment. When does it go bad? How much longer we have to wait here? It's certainly a potential. But just think sometimes the way no one's thinking. And no one's thinking this is an early stage environment and we got a 5 to 10 year kind of, let's call it more bullish cycle ahead. So, you got to consider all these different probabilities and possibilities in the market. You can't just, have your head in the sand and only think one way. Next one up here, Mike Wilson. We're 5% underweight equities. Man, that seems like not a very low number for being the biggest bear on Wall Street.
Can you be as cautious as you've been and not have a massive cash position? What is your cash position? How invested are you within your caution?
Yeah, I mean, we're basically 95% invested. We're like 5% underweight equities. And we've talked about this before. We never go 100% cash.
Yeah, but the financial media does. It makes for great theater.
Of course. Now, what we can do, Tom, is we can be positioned more defensively within our equity exposure, which is what we've done, right? So we're skewed more towards kind of defensive growth, late cycle cyclicals as opposed to we're not grabbing for beta. We're not grabbing for small caps. We're not grabbing for the stuff that's really kind of vulnerable if things go sideways.
Okay, you're with James Gorman. He's saying, Mike, I don't
look at how bad small caps have done over the past, what do we want to call it, 2 years or so, right? Guess what? Usually when small caps are doing very bad, that usually means you're actually in the end of a late stage environment, actually the beginnings of an early stage, let's call it cycle, okay? That's another one of those things to factor in there, folks. Okay, very, very important. You got to think about all these different things from different angles because the markets are telling you actually we're about to start the next cycle. And that's intriguing.
But in this blather, just tell me about the damn banks. I've been remiss on this. Yeah. Keefe Bruyette Index, you and I know it, we love it. And the answer is it's a grim chart. You go back to pre-California, pre-idiocy out there with one, you know the game that they went through. It's one of the barest charts I've seen in years. When do you know to load the boat on banks?
Well, look, it's the same story as the broader market, Tom. The bigger getting bigger. There's concentration, in the winners again. It's like the higher quality banks are performing
better.
So
are you long Apple?
Well, I mean, we are in many portfolios, obviously, because it's such a big part of the index. But Apple's another category of stock where people are paying up for the quality of the balance sheet, the lack of need for financing. But the banks are representative of the broader market, okay? The higher quality banks are outperforming the lower quality banks. That's just where we are for everything.
Lisa Shallot emails in. She says, ask Mike Wilson with his easy day job. She's got the real job, managing money. Do you buy an R-squared tight to the S&P 500? Or if I'm active managed, do I want to be idiosyncratic? Who did we talk to in London? Kathy.
It said who, what?
Kathy Wood Ark.
Oh, Kathy Wood.
Kathy Wood Ark. I mean, do I want to buy an R-squared tight to S&P 500, or do I want to get more idiosyncratic?
You want to be more idiosyncratic for sure this whole year, right? I mean, even though the S&P's outperformed, it's been 10 stocks. That's idiosyncratic. I mean, if you pick those 10 stocks, you did really, really well. If you pick the other 493, you didn't do very well. So the dispersion is really, really high, and it makes sense. Right now, the market's paying up for what I would call operational efficiency, cost leaders. It's paying up for good balance sheets. It's paying up for scale. Okay, will that change? Can we broaden out to the lower end of the market? If the market starts to believe that not only do we avoid a recession, but there's a reacceleration. That's what we need to see. That's what the market's trying to figure out. Hard landing, reacceleration. This purgatory land is we're just going to kind of slop back and forth, and the market's going to continue to gravitate to the lifeboats.
What does it mean to be defensive? And I keep asking.
And we did technically have a recession. Let's not forget that in 2022. We had a recession. No one called it a recession because the government decided not to call it a recession. But we did technically, Economics 101, you learn it, first year of econ class. We did have a recession, folks, in 2022. And one of the problems with the market and why we're still thinking, the thought process still late stage cycle is because they didn't call it a recession. So people are like, where's the recession?
Because some people say it's tech stocks. Some people say it's consumer staples. What do you say?
Well, I think it's both. Obviously the market this year has voted with its feet saying they want to buy large cap growth stocks, not just tech, but growth stocks with good balance sheets that have scale. And I want to point something out that's really important for these 7 or 8 stocks this year. Now, X one or two, most of the earnings recovery for these stocks has been a result of cost cutting. Right, they got over their skis on too much spending last year. They reined that in, and so they've kind of manufactured an earnings recovery. If they don't see top-line reacceleration, this is where we're starting to see a separation now, even in those 7. And I think that's going to be another story for the fourth quarter and next year's. The market wants revenue growth, not just cost-cutting stories.
What we're talking about right now is the bottom line. We're not talking about the rates picture and what that does overall to some sort of macro call on equities. Bank of America strategist came out today and said, do rates matter for stocks? And if so, it's not priced. Do you agree?
Well, for some stocks, it's mattered a ton, right? I just think, look, we said this at the beginning of the year. This is the most difficult part of the economic cycle. When you are late, we know we're late cycle for one reason, because we got full employment. So you can't argue we're mid-cycle or early cycle. That's silly. What you can argue is that the late cycle period can persist for a lot longer than people expected, and that's what's going on. Rates are the one wild card. The rates...
Yeah. I'll let him finish and then I'll go off.
Really surprised everybody, bond investors and stock investors. Normally in the late cycle environment, rates come down. Why? Because the Fed's done. As you know, this cycle is unique. That's the tricky part of the cycle, because the Fed can't be proactive in cutting rates ahead of the recession. So we're just going to ride this until basically you run out of gas. And that could be another year. We don't know the answers to that yet.
Yeah, so he mentioned late stage cycle there. Somebody count it. I think probably 5 to 7 times between like the 1 minute clip and the 4 minute clip. So 5 minutes he mentioned late stage cycle at least 5+ times, right? So that's kind of the consensus view, I think, on Wall Street late stage cycle, right? And he says, silly to consider anything else. Silly. I think we have to consider other possibilities. Remember what happened to consumer confidence in the Michigan Consumer Confidence Index in 2022. It hit the lowest numbers in history, Remember, real estate's in the worst place we've seen since the great financial crisis. Right now, okay, right now, actively right now, we have the worst real estate market since the great financial crisis. Look at how many homes are being sold. It's awful out there, okay? So you have a lot of phenomenons. You have companies going bankrupt. You have companies in very tough debt positions. So I think you just have to consider that we're in it right now, and we could be coming out in 2024 and beyond. It's something you have to consider, and to not consider it, I think, personally, is silly. You have to always think, what is everybody not planning for, what is everybody else not thinking? Just because everybody has a job does not mean everybody's doing great, okay? People got slapped by inflation and basically real wages that were going down for over 2 years. And we finally have started to have real wages start to go up again. Okay? Now imagine we keep inflation at bay and real wages stay in a great place in 24 and then 25. Oh, could you be in a much stronger economic environment given that, right? These are all things to consider. Meanwhile, companies are going to be making way more revenue because everything just went up in price, right? Obviously in 2021, 2022. These are all things that should be considered out there, folks. Don't just always put your head in the sand and only believe it's only this way and only that way. You've got to consider all these different potentials, because eventually some of those other potentials do happen, and then all these other people are like, how did we not see it? How did we not see it? Most people didn't even see the great financial crisis. Keep that in mind, right? So, and we are in a totally different situation where everybody's calling for GFC, and we might have already been going through it just without the unemployment picture, right? Appreciate everybody joining me as always. Thanks so much for being here, folks. Thank you for being subscribed. Hope you enjoyed today's video. Hope you got a lot of value out of it. Make sure you get the pinned comment down there. That's a free workshop I put together for you guys. It's about a 30-minute video, how I find 10x stocks. That should help you out tremendously. Once again, that is pinned comment. Take advantage of that here today. Much love and have a great day.